So tonight we'll be taking our discussion further on cost of capital. If you are following up with your syllabus very well, you discover that there are quite a number of issues under cost of capital, in which portfolio that we treated yesterday is also part of it. And today we are going to be looking at capital structure as it relates to cost of capital, and also under capital structure, we'll be talking about various theories of capital structure, such as the traditional theory. We'll be looking at the Miller and Modigliani theory as it relates to cost of capital. And also, we are going to look at capital asset pricing model as it relates to determining cost of capital, and WACC as a whole, that is weighted average cost of capital. So without much delay, when we talk about capital structure, please, you can take down your notes. Most of the things I will be saying might not actually be in my slide. Yes, the slide is comprehensive enough, but still, you can still, or when you watch the recordings, you can just put down some key points that might be necessary for you. Yes. So when we talk about capital structure can be described as the way and manner a company finances its operations. That is, you have a business. How do you source for finance? Do you use debt? Do you use equity? Do you borrow from friends and relations? So the elements that make up your source of finance is referred to as capital structure. So the capital structure is how a firm finances its overall operations and growth, that is by using different sources of funds such as equity, preference shares, debt capital, and so on and so forth. So a company's proportion of short and long-term debt is considered when analyzing capital structure. And most times, a company that is heavily financed by debt has a more aggressive capital structure. And in that case, it poses greater risks to investors. Now, when a company is highly financed by debt, it means it is highly geared, and there are associated risks attached when an organization is financed heavily by debt, because it can result into issues of liquidation, dissolution of an organization, whereby you are not being able to meet up with the debt demand. So capital structure will include ordinary share capital, reserves, long-time borrowing in the form of debentures, and so on. So sometimes companies rely on short-term borrowing like bank, overdraft, and short-term credits for considerable part of their capital structure, because they can easily source for that to meet their short-term needs. So it is, however, generally regarded as a good strategic and corporate financial management practice to finance long-term projects with permanent or long-term capital. We've analyzed this over time while we were discussing issues of investment appraisal. Yes, they are trying to see how organizations balance up their source of finance by using long-term source of finance to meet long-term needs, and use short-term source of finance to meet short-term need for finance, such as working capital and so on and so forth. So capital structure will always help to determine the current state and type of risk faced by an entity. Yes, when you evaluate your capital structure, you'll be able to evaluate the risk that you face. So a company's capital structure has a significant bearing on measures of its profitability and financial strength, such as the net profit margin, return on equity, debt equity ratios, interest coverage, and so on and so forth. So there can be a question whereby you'll be given the financial statement of an organization, and you'll be required to fish out the debt, the equity, and there can be additional information whereby you'll be required to evaluate and bring up the appropriate cost of capital using work that they can use to finance projects for future purpose. So basically, capital structure entails debt and equity. So when we talk about debt, debt is one of the two main ways companies can raise capital in the capital market. And companies like to issue debt because of tax deductibility benefits. You know, debt enjoying tax incentive, debt enjoying tax savings, tax shield. So it's a cheaper source of finance when you compare it with equity. With equity. So most times organizations are interested in picking up debt because it's cheaper than when you obtain equity. And when you obtain debt, the equity holders are often not happy because you are exposing them to greater risk. Yes, you're exposing them to greater risk. And we'll tend to see more of that using some graphs very soon. So also, equity is a more expensive way to finance a business. It's more expensive to raise debt than equity, or to raise equity than debt rather, especially when interest rates are low. So unlike debt, equity does not need to be paid back if earnings decline. Yes, because the equity shareholders, they share part of the burden of the business. Yes, especially if the business is a limited liability. You forgone everything you have in the business, but your personal properties cannot be used to pay back debt. I believe we all know this from our elementary knowledge. So what you will lose as a shareholder is based on what you have invested in a business. Unlike a one-man business whereby an extension of your personal properties can still be used to offset any debt that the one-man business is owing. So equity represents a claim on the future earnings of the company as part of the owners. So when we talk about capital structures, we also look at risk associated with this capital structure. There are basically two types of risk associated. We have business risks and we have financial risks. We mentioned that yesterday under portfolio, we talk about systematic risk and unsystematic risk. And the business risk falls under what? Under the unsystematic risk because it's specific to a particular line of business. Yes, to a particular industry. So business risk is a risk that is associated with the operations of a company. Yes, take note of that, please, without regard to the mode of finance. Yes, it means once you are into this line of business, you are born to face such kind of risk. So this is a risk associated with operating income or earnings. So it has to do with your operations, and it is a combination of your sales risk and operating risk. That is business risk. But financial risk is introduced when you start engaging in debt. When a business starts sourcing for a means to obtain loan, they introduce financial risk. So the financial risk is associated with how a company finances its operation. It is the risk arising from debt financing. So if a company finances its operation with debt and long-term basis, it increases its financial risk. Please take note of all this. Why are we saying this? You can see a question whereby the business is solely financed by equity. It means they are what? They are ungeared. Where a business is financed with equity and debt, it means what? They are geared. They are geared. Take note of this, please. So when you see question, you should be able to deduce from the question, is this business geared? Is this business ungeared? These are some terminologies that will make use of. So financial risk implies that the owners of the entity, that is the equity investors, will have the obligation to pay debt holders before they receive their own share of the profit. Yes. So for every business, the debts, you have to pay them first. Yes, I can see your hand raised up now.
And you said that a business, when a business finances projects with equity and debt, it means the
Yes.
company is highly geared
Yes, it's yes, yes.
with equity and finance. I thought it's when the company is dependent on debt.
No. When it is a combination of equity and debt, it means
Okay.
it is geared. But when it is
Okay.
solely on equity, it is ungeared. And
Okay.
it is, yes. And if a business is solely on debt, which is not good, it means they are highly geared. Geared. Yes. So, but when there is a
Yes, sir.
mixture of debt and equity, it is geared. It is geared. So once you start introducing debt into a business, it means that the business is being exposed to gearing, to gearing. So without much ado, based on that background, in a question, or there are scenarios whereby you might not need to change the cost of capital given to you in a question, or there are scenarios whereby you will need to derive another cost of capital, that is using certain formulas. Now, there are two reasons why the cost of additional finance raise is likely to be different from the current cost of capital. For example, in a business, you can have an existing cost of capital to be 6%. And there are certain reasons that might cause that existing cost of capital to change. One, if you look at the slide, you see that one is changes in the level of gearing. Changes in the level of gearing. It means when additional debt or debt is being introduced in a business, it will make your existing cost of capital to change. That if, for example, the new finance is to be raised entirely from equity, then two things will happen. Firstly, the level of gearing in the company will change, and this clearly will affect the weightings, that is the ratios of debt to equity. Yes, and the weight of debt to equity is WACC. And secondly, if we introduce additional finance, higher gearing will increase the level of risk for the shareholders, and therefore shareholders are likely to require higher rate of return, which will in turn increase the cost of equity, which I've mentioned earlier on. So the WACC is likely to change as a result of the way in which the new finance is raised. So when there is an introduction of a new way of financing a company, the WACC is likely to change. Now, this is it. For example, if equity is 40% and debt is 60% currently, and you went further to source for more debt, and in sourcing for more debt, the ratio of debt increased to, let's say, 70% compared to the old percentage, it means that the cost of capital will change as a result of what? The introduction of additional debt, and the weightings will change. It means if you are introducing more debts, debt can increase from, let's say, 60 to now be, let's say, 80 as the proportion of the capital structure, and equity might land to 20%. So this is what we're trying to portray regarding the use of existing cost of capital and a new cost of capital. Now, we said we have theories of capital structure. Theories of capital structure. The theories of capital structure. Yes, the theories of capital structure. Number one, we have the traditional theory or the traditional view in terms of capital structure. Traditional view. And this traditional view is also known as the intuitive view. Intuitive view. The traditional view has no theoretical basis. Yes, there is no theory to buttress this, but it is hinged on common sense. That is, in this traditional view, taxation is ignored in this theory. In this theory, taxation is ignored. So the concept of traditional view, we'll look at it in two ways. There is an instance where you will have low level of gearing. Low level of gearing, that is, whereby debt is newly introduced. At this point, equity holders perceive risk as unchanged. It means that when debt is newly introduced, the effect on cost of equity will not be greatly felt. So the increase in the proportion of cheaper debt as time goes on will lower the WACC. If you look at this graph, here, you can see this line here, equity. It means that equity will continue to increase upward sloping without the introduction of debt. If you look at this graph now, as debt is introduced, you can see the effect on WACC, that as debt is being introduced, WACC begin to decline. WACC begin to decline. So equity holders perceive risk as unchanged. So the increase in the proportion of cheaper debt will lower the WACC. As debts begin to increase, continue to increase, the WACC will begin to fall. It will now get to a point, the optimum level, which is this point, and this is the best point you can achieve in relation to WACC. And as the equity continue to increase and debt increase also, WACC begin to rise. So at higher levels of gearing, it means at the introduction of more debt, equity holders see increased volatility of returns as debt interest must be paid first. Yes, because those that offers their money to you, that gives you their money, you have to settle them first in paying what? Interest. In paying interest. So this leads to what? Increase in financial risk, exposing the equity holders to financial risk. And this increase also leads to increase in cost of equity. Yes, it leads to increase in cost of equity because a cheaper debt is being introduced and the equity holders are seeing themselves as being exposed to risk, and they want to increase their return. They want the organization to increase their return likewise, because you cannot expose us to more risk and we keep getting same dividend that you're giving to us. So as more level of debt is increased, cost of equity will increase, because you cannot keep introducing debt and engaging us in risk. We keep receiving the same value of dividend or return on our investment. So as more debt is introduced, cost of equity also increase. So as we have more debt, the WACC also increase. WACC also starts to begin to rise. So at very high levels of gearing, what happens? At very high level of gearing, when we have too much debt, debts increase beyond normal, what happens? There will likely to be serious case of bankruptcy. Yes, because worries begin to set in. And the equity and debt holders alike begin to worry. As cost of equity and debt rise, WACC rises likewise. So as the cost of equity increases, as debt increases, the WACC also increases. It means that the business is gradually facing serious bankruptcy problem, because there will be too much pressure on what the business is earning. The equity holders are demanding for high return. The debt holders are demanding for high return. The cost of financing the debt is also becoming high. It means that it can result into issue of bankruptcy. Now, to summarize this, the point is this: when debt is introduced into capital structure, the WACC falls, because the benefit of cheap debt finance outweighs any increase in cost of equity. What is the cheap source of finance now? It's debt. So the benefit outweighs the cost of equity. So this is what happens as debt is being introduced, and also as gearing continue to increase. As we introduce more debt, as gearing continue to increase, the equity holders will ask for increasingly higher returns. As you can see, it keeps increasing. Yes, they will ask for increasing higher returns, and also there will be increase in cost of equity. Which will outweigh the benefit of the cheap debt. So also the cost of debt will also start to rise. Because debt holders are worried about the security of their loans. So they will increase the interest. So shareholders also will continue to increase their required return, as you can see. And this will contribute to what? A sharp increase in WACC, as you can see here. To contribute to a sharp increase in WACC. So as an organization continues to suffer from high level of gearing, many financing problems will arise, and investors and owners will not be able to cope, and the company may finally liquidate. So all assets will be realized quickly at a cheaper price, and the claimant also will be settled in order of seniority. There is what we call, in terms of all these loans, there's what we call secured loan, unsecured loan. So when it comes to dissolution and settlement, there is priority on whom to pay for. So this point here, this optimal gearing level you see here, the WACC is at minimum. Minimum. So it is at this optimal level of gearing that the combined market value of debt and equity securities are maximized at the optimal level here. It is a point where the market value of debt and equity are best, where you can get the best out of them. So the traditional view suggests that WACC initially increases with increased gearing due to cheaper cost of debt compared to equity. However, beyond a certain level of gearing, the WACC starts to rise due to increased financial risk and the higher cost of equity, as equity holders demand a higher return for their increased risk. So this is the traditional view. So the assumptions underlying the traditional view is this: there is no taxation. There is no taxation in traditional view. This is one of the assumptions. And also in the traditional view, the companies pays out all its earnings as dividend. They pay out all their earnings. These are assumptions associated with this view now. There is no taxation. The companies pays out all their earnings as dividend. It means all their returns, their profits, it's been given out. It's been paid out as dividend. And also, as part of the assumption under traditional view, is that the earnings of the company are expected to remain constant in perpetuity till infinity. So it means their returns, their profits, is an assumption, will remain constant year in, year out. Year in, year out is an assumption. Some of these assumptions are not real, yes, in the real life settings, but based on the theory, that is what the proponents of this theory have come up with, and that is what they hinge their concept on. So also, as part of the assumptions underlying the traditional view, is that business risk is constant. Business risk is constant. Is also an assumption. And what is business risk at this point? Let me ask you. What is business risk? Talked about that over time. What is business risk? Yes. Business risk. I hope you are not cooking.
That's all systematic risk.
Okay.
The risks that are peculiar to a particular business. Okay.
All right. So these are risks that peculiar to particular form of business or industry. So as also part of the assumptions underlying the traditional view is that the capital employed in the business is also constant. The capital employed can be debt and equity, and also that there are no transaction costs for issues. It means when you issue out equity, when you call for public offers for shares, there are no issuing costs. Some of these things are not real, but based on this concept of traditional view, these are the underlying assumptions. The underlying assumptions. So it gets to a point whereby all these concepts are put away. Yes. So that is why we will still look at the Miller and Modigliani. Yes, I can see your hand raised up.
The last assumption, did you say capital employed in the business is what?
Yes. Yeah.
I didn't get that.
The capital employed in the business is constant.
Oh, okay, thank you.
So this is a traditional view of cost of capital. We have the Miller and Modigliani, popularly known as M and M. M and M. They came up with a theory in 1958 that there is no need for taxation just similar to the traditional view when trying to look at the issue of cost of capital. Miller and Modigliani, they ignore tax in their theory. Likewise, Modigliani and Miller proposition. So, what is their argument? What is their argument in relation to the fact that there is no taxation? The M&M argue that as investors are rational, the required return of equity is supposed to be directly proportional to increase in gearing. It means as we introduce more debts, the return on equity likewise should increase in that same proportion. So what they're just trying to say is that there should be a linear relationship between cost of equity and gearing. Between cost of equity and gearing. That is Miller and Modigliani without taxation. And also, they put forth that the WACC will remain unchanged. Let me see if I have a diagram regarding that. The WACC will remain constant. Yes. The WACC will remain constant over time. This is so this is a graph to illustrate Miller and Modigliani without taxation. That WACC will remain constant. WACC will remain constant. It will remain unchanged. But the increase in cost of equity will offset the benefit of the cheaper debt. That is their own theory. So they put forth that the WACC and the value of the firm are unaffected by changes in gearing level. Please understand that value of ungeared is equal to value of geared. That is their preposition, that irrespective of the level of debt and equity, the value of the firm will remain same, without any change. So the WACC and the value of firm are unaffected by changes in gearing level, and gearing is what is irrelevant as far as this preposition is concerned. So the implication for finance is that choice of finance is irrelevant as far as this concept is concerned. Miller and Modigliani without taxation. It means irrespective of equity, irrespective of debt, irrespective of how you mix your capital structure, it is irrelevant in this regard. It's irrelevant. So, as you can see, the WACC still continues. As more debt is introduced, the WACC remains constant. So, the assumption underlying this theory is that there is no taxation, likewise. And this assumption is also based on the fact that there is perfect capital market. Yes, that is one of the assumptions, that there is perfect capital market, that the world is a perfect place. Everything works as expected. That there is perfect capital market where investors have the same information upon which they act or react rationally. You know, as part of the features of a perfect market is that everybody in the market must be aware of the prevailing circumstance in the market. And also, they are also putting forth that there is no transaction cost and that debt is risk-free. These are their assumptions, the underlying assumptions. So by implication, what this is telling us is that the WACC of an ungeared company is the same as the work of a geared company. Now, an ungeared company is what? Can I get a response? An
Something that does
ungeared
not
company.
depend on debt to finance its project. That's one on jet companies.
Okay. Can you come again, please?
A company that don't depend on debt, any form of debt to finance
Okay,
its
fine.
projects.
All right. I mean, it's raining here, so I'm trying to get to comprehend what you say. So when a company is on debt, it means they don't depend on debt. In the case of Miller and Modigliani without taxation, what they're trying to tell us is that work of ungeared is the same as work of what? Geared.
Good.
So the value of an ungeared company is the same as the value of what? Of a geared company. Now, how do we express that? This is it. This is it. This is it. That is Modigliani and Miller's argument ignoring taxation can be summarized as two propositions. That is, market value of geared is equal to what? Market value of ungeared. Of ungeared. So the proposition that the work is constant at all levels of gearing for companies with identical annual profits and identical business risk characteristics, their total market value, that is equity plus debt, would be same regardless of the difference in gearing between the companies. And the proposition 2 is that the cost of equity rises as the gearing increases. So the cost of equity will rise to a level such that given no change in the cost of debt, so the work remains unchanged. So this is also showing the expression, what we've put forth, that in relation to preposition 1, that the work in a geared company and the work in an identical but ungeared company are same. So it is represented with this. That is, total value of an ungeared company is equal to total value of an identical geared company, as you can see. So for preposition 2, that the cost of equity in a geared company is higher than the cost of equity in an ungeared company. That is, the cost of equity in a geared company is equal to the cost of equity in an ungeared company plus a financial risk premium. So since the cost of equity increases as gearing increases, the cost of equity of an ungeared is less than the cost of equity of a geared company. So in a scenario whereby we want to determine how the cost of equity in a geared company is higher than the cost of equity in an ungeared company, this formula can come up. That is cost of equity geared. This KAG is cost of equity geared equal to cost of equity of ungeared plus debt, market value of debt divided by market value of equity multiplied by cost of equity ungeared less cost of debt. Less cost of debt. We're going to see an example to illustrate this. Let me see. All right. This is an example. Can somebody read, please?
An all equity company has a market value of 150 million and a cost of equity of 10%. It borrows 50 million naira of debt finance, costing 6%, and uses this to buy back and cancel 50 million of equity. Tap relief on debt interest is ignored, required. According to Modigliani and Miller, if taxation is ignored, what would be the effect of the higher gearing on A, the work, B, the total market value of the company, and C, the cost of equity in the company.
All right, thank you, ma'am. So looking at this question now, you need to take a closer look at it again. That an all equity company, what is the interpretation of that?
Ungeared.
Very fine. Ungeared. That an all equity company, it means the company is free from debt, has a market value now. See that of what? 150 million. Market value of 150 million. And a cost of equity of 10%. It means the cost of equity is 10%. Now, it borrows 50 million of debt finance, costing 6%, and uses this to buy back what? To buy back and cancel 50 million of equity. It means we are having 150 million equity, right? Now, we want to cancel 50 out of it. We want to buy 50 out of it. So when we buy 50 out of 150, or when we return 50 million out of 150, how much do we have left?
100.
100. Fine.
100 million.
100 million. And uses this to buy back and cancel 50 million of equity. So what is the implication of this? What is the implication of this? You borrow 50 million, right?
Yeah.
You use it to cancel 50 million out of your 150 million. So when you look at it, how much do you still have?
Still have 150.
It's 150
Fine.
million.
Yes, you still have 150 million. But now, there is a mix now. A mix. Before, you were only on equity. But now,
Equity.
you are now what? Equity
It's
Yeah,
both
not
equity and debt. It's not geared.
Yes. Yes. So you are now having equity to be 100 million and what? Debt to be
Debt.
what?
And debt 15.
50 million.
50.
50 million. So now, the work of the organization, according to the traditional view, is that what? Work of ungeared is the same thing as work of what? Geared.
Okay.
That is their own concept. So based on this, according to Modigliani and Miller, the work will remain unchanged. At what? At 10%. The work will remain unchanged at 10%. That is their own view. That is their own view, the traditional, the Miller Modigliani without taxation. That according to Modigliani and Miller, if taxation is ignored, what will be the effect of the higher gearing on the work? On the work. The effect, there will be no effect on gearing because you are still having what? 150 million overall. 150 million overall. So the work will remain unchanged. The work will remain unchanged. But the point now is, what will be the total market value of the company? The total market value is still same, right?
150.
The total market value of
150
the
million.
company is still 150. It's still
150
150.
million.
Yes, because equity is still 100, is now 100 against 150, and debt is what? Is now
It's 50 million.
50 million. So the overall market value of the company is
150
150. Yes, comprising of 50 million debts and 100 million equity. Now, that's the cost of equity in the company. Now, what is the cost of equity in the company?
It's
You know, we showed
yeah.
the cost of equity now. The cost of equity now. Since we've introduced, now we're just trying to see the cost of equity.
10%. It's still 10%.
Yes, that is
10%.
okay. Let's go back here. Now we're trying to use preposition to now. The cost of equity in a geared company is higher than the cost of equity in an ungeared company. Now, you know, before now, the organization is solely ungeared, right? Now,
Yes.
we've introduced debt. It is now what? Geared.
It's not geared.
It is now geared. It is now geared. So, if the cost of equity in a geared company is higher than the cost of equity in an ungeared company, the cost of equity in a geared company is equal to the cost of equity of an ungeared company plus a financial risk premium. A financial risk premium. So we'll now use this formula to determine our cost of equity geared. We use this formula now to determine your cost of equity geared. Your cost of equity of ungeared is what? When it is ungeared, the cost of
10%.
10%. Very good. 10%. 10%. Now, what is your debt? The market value of your debt?
50 million.
It's 50 million.
Fine, 50. Equity is now what?
50 million.
Equity is now what?
Equity is 100 million.
100.
100.
100 million.
Fine.
100 million.
Into the bracket of your cost of equity on geared is what?
10%.
10%.
Cost of debt is what?
6%.
6%.
6%.
So when you solve now, you will now determine
16%.
your cost of equity geared.
Hmm.
Twelve percent.
12%. So hope everybody's getting 12%. Are we all getting 12%? I want to get a confirmation. Some people are eating.
It's me, oh.
Okay, please, can you explain the how to substitute this formula again?
Yes.
Cost of equity on geared. The value is what? 10%, right?
Yes, sir.
10%. So plus you this plus from plus, kindly put a bracket. That is this D over E is in bracket, right? Multiply by, once you get 50 over 100, then 10 minus 6% will give you what?
4%.
Then you
4%.
you multiply.
Again.
You multiply by the result of D over E.
That's 50 over 100.
That's yes.
4.4.
Please. Hello,
Alright,
Mr. Papa.
fine.
Please, I need a sort of a recap. I didn't get it.
It's 12%, sir.
12%.
So, all right. So, cost of equity on debt is 10%, right?
Okay. Yes.
Plus, into the bracket,
Okay.
50 divided by 100. 50 divided by 100, you have what? Multiply by 10 minus 6.
10 minus 6.
So when you do that, you have what, man? Have you gotten it, man?
Oh, yes, yes. I've gotten it.
Let's take it further. So we have Modigliani and Miller with taxation. In 1963, they observed that most of their assertions and assumptions does not hold water. And they decide to come up with another theory telling us that let's incorporate tax into what was put forth before. Due to a number of practical criticisms which was leveled against their theory regarding no tax. But the point is this: the most significant part of that theory was the assumption that there were no taxes. So since debt interest is tax deductible, since debt is tax deductible, the impact of tax could not be ignored. It means there should be an introduction of tax. Since we have the element of debt, and debt has a tax shield, debt has a tax savings, and you cannot completely eradicate the effect of tax in your computation. So in 1963, the M&M model was modified to reflect the fact that corporate tax systems gives tax relief on interest payments. Hence, the need to introduce tax into the formula. So the theory states that that is M&M model now with taxation. The theory now states that as investors are rational, the required return of equity is directly linked to the increase in gearing. So as gearing increases, the return on equity also increases. So it means there is a direct relationship, there is a direct proportion in relation to the required return on equity and gearing. And also, debt interest is tax deductible. So the overall cost of debt to the company is lower than M&M without taxation. So with taxation, debt is much cheaper because the effect of tax is set in. Unlike the first one, whereby we ignore the issue of tax, it means debt is a high cost of finance. But now, with the introduction of tax, debt is now being seen as a cheaper source of finance. So the lower debt cost results in less volatility, that is in returns for the level of gearing, which leads to lower increase in the cost of equity. I don't know if I have a diagram to illustrate that here. Okay, yes. So when you look at this, that Modigliani and Miller therefore reached the conclusion that because of tax relief on interest, there is an optimum level of gearing that a company should be trying to achieve. So a company should be trying to make its gearing as high as possible to the maximum practicable level in order to maximize its value. So the conclusion they reach is that organizations should try to keep getting debts because of the tax savings on it, even though it has its own implication. So, in conclusion, so that we'll go to computation. Oh, okay, still have to talk about some CAPM. So, I just want us to go to the reality, even though there are questions on theoretical questions on this, all these we've discussed. I will forward immediately after the class theoretical questions from ICANN on you explaining traditional view, explaining the concept of M&M model with taxation and without taxation. So in conclusion, as regards this, geared company has a higher market value and a lower WACC than ungeared company because they pay less tax compared to what ungeared company. You know, ungeared company don't. Because they don't have debt as part of their as gearing increases. I'm having network issues. Sorry about that. As gearing increases, the WACC steadily what? Increase. You can see that in this graph. As gearing increases, the WACC too is following. So the introduction of taxation suggests that the higher level of taxation, the lower the combined cost of capital. It means the cost of debt is reduced. So the more the tax, the more benefit you enjoy. So the logical conclusion is that companies should choose 99.9% gearing level based on these assumptions of Miller and Modigliani with taxation. So this explains that because of tax relief on interest, there is an optimum level of gearing that a company should be trying to achieve. So a company should be trying to make its gearing as high as possible to the maximum practicable level in order to maximize its value. So now, let's look at some formulas regarding this. Okay, so I'll talk about this. Let us waste time on it. Miller and Modigliani formula. Okay, all right. So this is without tax that we talked about, and this is with tax. So that the WACC of an ungeared company is less than the WACC of what? Of a geared company. So with tax, we have value of geared is what? Is equal to what? Value of ungeared plus what? Plus debt. And this debt is with what? Is with tax. Is with tax savings. Unlike in this one where we don't have tax. It is just equal. Value of geared is equal to value of ungeared. Now, the cost of geared, cost of equity geared now, cost of geared is equal to cost of ungeared plus what? Because of tax, the debt element, we enjoy what? Tax savings, 1 minus T, divided by what? The market value of equity, multiplied by cost of equity ungeared, less cost of debt. And also the WACC overall, the WACC of geared will now be what? Equal to WACC of ungeared into the bracket of 1 minus what? Tax, divided by what? The debt market value divided by the overall market value of the organization, which is debt and equity. So the various items are defined. VG is value of geared firm, value of ungeared firm, and the rest of it. So now we are driving at somewhere. Yes, there is a place we are driving at. And in some questions, you can be operating in the agricultural industry or sector, and you are now seeing an opportunity in the mining industry. You are seeing an opportunity in mining industry. It means that you want to diversify. And once you want to diversify, it means as part of your overall portfolio, you want to introduce additional security, additional investment. And that can affect your risk, overall financial risk as an organization. So you need to look at a proxy company, an existing company in the mining sector that is operating. What are the financial risks they face? What are the business risks they face? So you use that as a proxy. You use that as a model that you are going to work with. But for you to do that, there are various steps that we must follow to determine that. There are various steps we must follow to determine that. And the steps will include you identifying a proxy company, you know their risk, you ungear their risks and the rest of it. And okay, let me just talk about that. I wanted talking about capping, but we'll get to a point where we will, in the steps, we'll show capping. We'll show what happens. That is capital asset pricing model. We'll show what it entails. But let's just show the steps so that we can now pick a question and solve. Pick a question and solve. So you can write. I think I have the steps in my slide, but I don't think it's comprehensive enough. Let me see. Okay, that's right. Let's take it down. So we have steps. We want to look at where we have a particular project at hand. So steps involve in computing project-specific cost of capital. Project-specific cost of capital. Project-specific cost of capital. Steps involved in in calculating projects specific cost of capital. Project specific cost of capital. We have one. Identify the beta. Identify the beta. The beta. We have two types of beta. Who can tell me?
Asset beta and equity beta.
Asset beta and equity beta.
Equity beta, yes.
Yes, asset beta and equity beta. Now my question is this. What is asset beta? Asset beta. So let me say it. Please, you can write it down likewise before I go ahead with these steps. But in general, when we talk about beta, beta is a measure of risk. Likewise, beta is used to measure risk. And we have asset beta, we have equity beta. Asset beta is used to measure the risk associated with the industry in which a company operates. Asset beta. It will be given in the question. So you don't need to begin to think, how will I be getting beta now? Yes, the question will point to it, most likely, yes. So, and it might not be clearly written as asset beta, it can be stated as what? Maybe the business risk or systematic risk, something like that. So asset beta is used to measure the risk associated with the industry in which a company operates. What asset beta does is that asset beta measures only business risk. Business risk. Business risk. It measures business risk. It measures business risk. So we also have equity beta. Equity beta. Equity beta. This is a measure of business and financial risk. And equity beta, take note, equity beta is usually greater than asset beta because it contains what? Both business and financial risk. It contains both business and financial risk. So for you to get your equity beta or your asset beta now, for you to get asset beta, you use this approach, this formula here. Asset beta is equal to I want to represent that formula. This formula will always be behind your answer booklets or your question paper rather. So beta so this beta asset beta will be equal to what? It will be equal to equity beta geared all these in brackets, please. Equity, market value of equity, divided by what? Market value of equity plus market value of debt into the bracket of what? 1 minus what? C plus it closes brackets, please. Plus debt beta in relation to debts. You know, debts always have past savings divided by what? Market value of equity plus debt. Yes. So this is the formula to determine what? Asset beta. That is where debt beta is given. That is where this is given in the question. Please take note. Where debt is given, let me write it. Okay, let me write it here. Where debt beta, that is this value here. That is where debt beta is given. Where debt beta is given. Please take notes. Where debt beta is given. Most likely, the question might not give you debt beta. So where debt beta is not given, or where debt beta is 0, what would be your asset beta? Where this debt beta is 0, what will be your asset beta? Anybody to try?
It will only be beta.
The second side of this equation will be 0. Then
Fine.
it will just be equals to this first part
Yes.
plus 0.
Yes. So when you are reading the question, take note. Do I have debt beta? If no, you ignore this part. As a matter of fact, most times you will not see it, but you don't know what the examiner might come with. That is why I'm showing it. Yes. John is now introducing debt beta. you had to come up with this whole formula, which should be given to you in the question paper. So where debt beta is equal to 0, it will only be, let's show that, let's write it out so that we not get, where debt beta is 0, the debt beta is 0, it will be the formula will just be this part here. Yes, just this. Please take notes, as I always say. When you go to some books, they can write this in another way. Yes, they can write this in another way. Don't get confused. Get used to a pattern and follow it. And I think this is what is in the study, in the past question. Yes, because you can see the first formula I showed. This one, where is it? You can see this value here, equity beta. You can see where it is being placed. You can see where debt beta is placed here. You can see it. So don't get confused by all this. So I just have to come and reproduce it this way now. You will get same results. Because when you go and look at some other books, some things, you might see different things. They are all talking about same thing. So I believe we know the definition of all this. This is asset beta. This is what? Beta equity geared. Beta equity geared. Beta equity geared. And this is what? Market value of equity, the E. And the D is what? Market value of debt. And T is what? Corporation tax. T is corporation tax. So this is for asset beta. Now, equity beta, we said it measures what? Business and financial risk. It measures business and financial. So how do you get equity beta? How do you determine equity beta? We have it as equity beta. It will be equity beta gear equal to asset beta in the bracket of what? One plus open brackets. It can be, yes, can be written in different way. 1 minus t. When you see 1 minus t, what should come close to it?
Tax. 1 minus
Debt.
tax. Debt.
Debt.
Divide by what? Equity.
Equity.
Divide by equity. Then you close your brackets. So this is for equity beta geared. Where you're trying to get your equity beta geared, we use this approach. It means in the question, you must locate your asset beta. Then the market value of debt, market value of equity. The question should give you the tax value, the tax rates, likewise. Then you substitute, you get your equity beta geared. Your equity beta geared. So moving back to
Sir, please, so you say the D stand for what and the E?
market value of debt, market value of equity.
Okay, thank you, sir.
We've defined these in our first class, ma'am. Likewise, all these ones are just recap. I just don't want to say, we've done it before. So it's market value of equity, market value of debt. So steps. Where is it now? Steps involved in calculating project-specific cost of capital. Number one, identify the beta. What kind of beta? Equity beta. Equity beta of a proxy company with proxy company in the new industry you want to invest in the new industry. Identify the beta of a proxy company in the new industry and confirm whether it is geared or ungeared. Confirm whether it is geared or ungeared. Now, once you confirm that, a geared beta is an what? Is an equity beta that what? That incorporates both business, and what? And financial risk. Both business and financial risk. And let's say now, whereas an ungeared beta measures only business risk. So another word for ungeared beta is what? An ungeared beta is what? Is an asset beta. An asset beta. So once you're given a question and the question is telling you that this particular organization wants to diversify, and they are now telling you that there is an existing company in that new industry they want to diversify into, what do you look out for? You look out for their beta. You look out for the beta. So you identify. The question will put it in a way. If it is an asset beta, if it is an equity beta, you will know. So once you identify the beta, if it is an equity beta, what do you do? It is an equity beta, which equity beta is what? Equity beta is what? Is a beta that comprises of what?
Both business and
Business and
financial.
financial risk.
Fine. Fine. So once you know it's an equity beta, what will you do? You ungear. You ungear. Why are you ungearing? Why are you ungearing? You want to remove the financial risk, that debt risk, and just look at the specific business risk that businesses in that particular industry face. Why are you ungearing? Because your own capital will be different from that business, that proxy business. You understand? You have your own structure of capital already. So you cannot adopt that into your own portfolio, into your own business. So what you just want to detect is the business risk that that organization or those organizations operating in that particular industry are facing. So that is the reason why you ungear to get what? Just the business risk. To get just the business risk. So the next step is what? You ungear. You ungear. The first step, we said what? Identify
The beta.
proxy. Let me highlight it, please. This is very important. This is the step. I don't want to give you a summary of the steps I have. I have the steps already, but let's do it well. So the first thing, identify the proxy company. The next is what? Ungear. Ungear. Ungear what? If proxy beta, if proxy beta is what? Is geared. It is geared because there's an element of debt in it. If proxy beta is geared, in order to remove the financial risk, so, and this can be calculated. It can be calculated as follows. That is using debt equity proportion of the proxy company. Using debt equity proportion of the proxy company. So, and then how do we calculate it now? I think I have that in here. That is, we use this now. So you use that formula. Use that formula. Use this formula now. That is, you need to get just the business risk, and asset beta will now be what? Equity beta geared. That is of the proxy company now. Of the proxy company. So the point is, somebody should ask me a question, that what of if the asset beta is given directly? What will happen? If the asset beta is given, what will happen? Any idea? If asset beta is given, what will happen?
Step 2 above should be given.
Okay, fine. Step 2 above should be ignored. Should be ignored. Then proceed to this
Step 3.
to the third step. The third step. Now, the third step will be what? You regear. You now regear. Now, when you are regearing, what will happen? You introduce debt based on your own capital structure now. Please take note. Now, this first step is based on the new industry you want to set up into. Now, this third step, you now start using your own components of what? Capital structure. You regear. You regear. You regear. This is on gear. On gear. Then here, you regear. You regear. You regear. Regear the asset beta. Regear the asset beta calculated in step what? In step 2. In step 2 above. In step 2 above. That is, if the new project is financed with debt capital. With debt capital. So this is necessary in order to account for the financial risk. The financial risk that reflects the method of financing. That is using the debt equity proportion. Using the debt equity proportion of the investing company. So how do you determine this now? You can use the formula. Okay, there is a formula we showed not quite long. You can use this formula. That is equity beta geared equal to what? Equal to the asset beta asset beta into the bracket of what? Asset beta into the bracket of 1 plus the bracket of changes 1 plus bracket of what? 1 minus t in relation to what? To debt divided by what? Equity. So you regear, because when you are regearing, you already have the assets, the business risk of the new industry. So you now plug in the business risk into your own capital structure to see what the effect will be in relation to equity beta debt. So you now use this formula. So once you do this, you now move to the next step. The next step is what? Calculate the cost of equity. Calculate the cost of equity using what? Using capital asset pricing model. Using capital asset pricing model. Now, capital asset pricing model. What is capital asset pricing model all about? I will talk about that briefly here. Yes, I'm supposed to have talked about it, but since I know this step will come, I'll talk about that here. So capital asset pricing model is also an innovation that is related to portfolio theory. Yes, it's one of the most significant innovations associated with portfolio theory. The capital asset pricing model was introduced independently by William Shape, even John Lintner and Jack Terrion and Jan Maxim, they independently introduced this theory of capital asset pricing model. Now, yesterday I made mention of Harry Markowitz as he introduced the concept of diversification and modern portfolio theory. So what all these other scholars have done is to build on what Markowitz has done. So the model, capital asset pricing model, provides a linear expected return beta relationship that precisely determines the expected return given the beta of an asset. So capital asset pricing model is a model that describes the relationship between systematic risk and expected return for assets. And the capital asset pricing model is widely used throughout finance for the pricing of risky securities, generating expected returns for assets, given the risks of those assets and calculating the cost of capital. So what capital asset pricing model does is that it asserts that the expected return of assets vary only by their systematic risk as measured by beta. So since unsystematic risk can be eliminated through diversification, so two assets with the same beta, we have same expected return, irrespective of the nature of those assets. That is capping for you. So this capital asset pricing model also has its own assumptions. It has its own assumption. It assumes that investors are risk averse and that utility maximizing and rational individuals is what investors are. That investors maximize utility and investors are rational in their decisions. And also it assumes that market is perfect. That is, market is frictionless. The market is without impediment. And it also states that Markets include no transaction costs, and it includes no taxes. And more so that investors plan for the same single holding period, which is not true. It cannot hold water. It also assumes that investors have homogeneous expectations or belief. This is not real, but these are assumptions put forth by these scholars. And also they assumes that all investments are infinitely divisible. Yes, that all investments are divisible, which is not true. We have investments that are not divisible, indivisible projects. And they also assume that investors are price takers. This also is not seen as being true. Investors can bargain in the real world scenario. So investors are not suddenly price takers, but this theory is telling us that they are price takers. So the general idea behind capital asset pricing model is that investors need to be compensated in two ways. One is the time value of money and risk. So the time value of money is represented by the risk-free rate in the formula, which I will show. It's a very simple formula. And the risk-free rate is customarily the yield on government bonds or treasury bills. That is, we established that government securities are risk-free. So let's just show the formula. Let's show the formula. Let's see what the formula looks like. The capital asset pricing model formula, what it looks like. So we have it as Rx is equal to Rf plus what? Plus beta plus beta plus beta to the bracket of what? Rm minus what? Rf. What is the interpretation of all this? Rx is equal to what? Expected return of the assets. Expected return of the assets. And what? Rf is what? Is risk-free rates. And what? The beta so the beta, let me just use B for it. Let me use the beta is equal to what? The beta, that is beta factor. Beta factor, that is what? Measurement of risk. Measurement of risk. And also we have what? Rm. Rm is equal to what? Expected market return. Expected market return. And also we have what? Yes, the combination of Rm, because in some questions they will not give you all this. Rm minus Rf is equal to what? Risk premium. Risk premium. Risk premium. So this is capping. Now, once you get to the fourth step, you calculate your cost of equity using CAPM based on this formula as seen here. And we're going to solve some example on CAPM, but let's just finish the fifth step now, which is the last step. The fifth step in relation to specific cost of capital. Specific cost of capital is this. The fifth step in relation to specific cost of capital is this. That is we have calculate project specific weighted, that is the work now, weighted average costs of capital. That is work. Sorry, I'm taking my time because this is something that is giving people headache at the advanced level. So I want you to pass this course and pass it and go, because they definitely test you on this. So that is why I have to. In my previous videos over time, I don't think I've done this while teaching the SFM class. So I don't want it to look ambiguous to you. So that is why I'm taking my time. So calculate project-specific weighted average cost of capital work based on weighted average cost of equity and costs of debts. And cost of debts as follows. Let me go and look for this formula. I think I should have it somewhere. Wow. Okay. So you can see my steps, the summarized steps I have. Okay, I can't even copy it. So this is the step, the formula you have to apply for the last step. Calculate, you can write it in case you're writing. Calculate the project specific weighted average cost of capital based on the weighted average cost of equity and cost of debt as follows. So this is the formula. WACC is equal to cost of equity multiplied by market value of equity divided by the overall market value of the organization, and cost of debt 1 minus T, debt equity plus debt. Yes. So once you do this, what will now be the next step? Once you do this, the next step will be what? Once you do this, the results you derive, your work, the work calculated, above will then be used to evaluate, or discount the cash flows of the project. For the purpose of NPV. So these are the steps. So let's look at some examples on CAPM, capital asset pricing model. Before we now pick an example on this project-specific cost of capital, without any much delay, let's see. Okay, yeah, this is an example we've solved already. Now, the question returns that what? The rate of return available for investors on government bonds is what? 4%. The average return on market investment is what? 7%. The company's equity beta is what? 0.92. Using the CAPM, the company's cost of equity will therefore be what? This is the formula. Yes, earlier I represented this as RS, can be RE, anything. So the company cost of equity is what? The formula, the risk-free rate plus the beta into the bracket of what? Market return less the risk-free. Now, from this question, the risk-free rate is what? They will not write it clearly, but they will tell you that the rate of return available for investors on government bonds. Government bonds are what? Risk-free, isn't it? So the risk-free, the rate of interest is what? 4%. The beta, equity beta is clearly given, and the equity beta is what? 0.92. See here, 0.92. So the market return is what? The market return, that the average return on market investment is what? 7%. Less the risk-free rate, which is 4%. So when you do your computation, you get your cost of equity based on CAPM formula. Yeah, cost of equity based on CAPM formula. So once you do that computation, 7 minus 4 multiplied by 0.92 plus 4%, you must always attend to things in bracket and multiplication first before moving to any other thing. Okay, all right, I think I have another question. So I want us to solve that. Let's see. It's just a very simple one. So this is an example. Can you solve and tell me what would be the required return? That QPLC has a beta of what? 1.5. The market is giving a return of 12% and the risk-free rate is 5%. What would be the required return from QPLC? The required return will be what? I can see people going to sleep already.
Yeah, with you, sir.
Yes, I can see some people, maybe their network, the number has reduced. So, let me see. Somebody is not. Let's see.
I have 10.85%.
10.85%.
Yes.
10.85%. Can you check again, ma?
Okay.
Okay, sir. I can see your network on your side. All right, it's fine, sir. Get the video available to you. Hope every other person is trying. Madam Tonani, hope are you? Madam Dayo Ade, Madam Nobu, Madam Ruth, Madam Tai.
That's one.
I have 23.
23.
I got 15.5.
I got 19.5.
If you are not getting 15.5, you are not correct. 15.5. If you are not getting 15.5, something is happening. Check it again. 15.5. So everybody get 15.5.
15.5.
Fine. 15.5. All right, let me just set up the class for FR makers. So we're going to, for this couple, this is just to show what you are to expect and how to apply the formula. Let's take it further. I have quite a number of examples. You can see class exercise and the rest, assignments and the rest. So we talked about all this. Now, this is the question I want us to treat. Yes.
So the first example was the beta FICO.
0.92.
Okay, thank you.
All right, thank you. So this is a question. Can somebody read?
PM
Can we
produces
read
hot
it?
air balloon. Its equity. Yeah. PM produces hot air balloon. Its equity debt ratio is 5:2. The corporate debt, which is assumed to be risk-free, has a gross redemption yield of 11%. The beta value of the company's equity is 1.1. The average return on the stock market is 16%. The corporation tax rate is 30%. The company is considering a waterbed manufacturing project. Moyo is a waterbed manufacturing company. It has an equity beta of 1.59 and equity debt ratio of 2:1. PE maintains its existing capital structure after the implementation of the new project. What would be a suitable risk-adjusted cost of capital for PE to use or apply in evaluating the proposed project?
All right. Thank you, Ma, for that. So looking at this question, what can we bring forth? What can you deduce from this question based on what we've been discussing over time? What can you analyze? Yes, assume this is what you are seeing in the example. What are the variables you can come up with? Yes.
Thing is trying to diversify, and Moyo here is a proxy company that is already in the industry.
Yes. Yes. What can we bring forth again? That's me produces that 3 minutes trying to send a message. Anybody doing FR here?
Yes.
sir.
Okay, all right, it's okay. I don't want to send a message to you. You round up before your class. And the question I forwarded on the platform, I'll just do a brief analysis. You can see the question is so long that it's what you need here is just small. They will just put forth paragraph of messages of literatures for you to be reading. So what is required in that question is just few after we've solved all these. So now, looking at this question, when you produce hot air balloon, its equity debt ratio is what? 5:2. Now, in this question, you can see they are not giving you the overall market value, right? But they are giving you the proportion. They're giving you the proportion that equity is what? 5. Debt is what?
It's 2.
2. The corporate debt, which is assumed to be risk-free, a gross yield of what? 11.
Redemption of
11%. And the beta value of the company's equity is what?
1.1.
Yes, the beta value of the company's equity is 1.1. 1.1. And also the average return on stock is 16%. Average return on stock is 16%. Market return. The corporation tax is 30%. The company is considering a waterbed now. There's a diversifying now. Manufacturing project. Moyo is a waterbed manufacturing company. It has an equity beta of what? 1.59. And an equity to debt ratio of what? 2
to
to
1.
1.
Sure, 2.
So FII maintains its existing capital structure. It's existing. What is FII existing capital structure? 5:2, isn't it? 5:2.
5:2.
After the implementation of the new project. So what would be a suitable risk adjusted cost of capital for FII to use and apply in evaluating the proposed project? So the first step is what? The proxy company is what? Moyo.
Moyo.
Now, for Moyo, do you have the equity beta? For Moyo,
We have
do
what?
you have the equity beta? The equity beta?
1.59.
Yes,
Yes, sir.
1.59.
1.9.
Fine. So what is equity beta? What is the component of equity beta? We explained. If you copy down those steps, you'll see it. What is the component of equity beta?
A major finance and business risk.
Very good. So now, since you want to, what are you interested in? What is FII interested in Moyo?
Business risk.
Business
Fine.
risk.
Business. Very good. So you need to remove the element of what?
Or financial risk.
Finance aspect of
Financial risk.
Yes.
Okay.
Yes. So you now go to that formula now. What is the formula we have to use?
Business risk.
That's a better assets is equal to better equity gained. Open bracket equity over equity plus equity and the tax element. 1 minus T.
Very good. In this case, we are not giving that other part.
They're not relating to.
So we quickly work.
So I bet sure the formula.
You're not right.
Is on step 2.
So
Okay.
this is it.
Okay, I have it, sir.
Yes, I was expecting everybody to write it. So that's when we are explaining. So now, based on this now, can you substitute into the formula? This is it now. You are trying to get the asset beta. Trying to get the asset beta. Now, what is your equity beta gear?
Okay, from the question.
1.59.
Okay.
The value of your equity is what? For Moyo? The
It's
debt
1.9.
proportion. Debt proportion.
Okay, that's
You are not giving it overall.
ratio. Yeah. Ratio 2.
2:1. No, debt is 1.
Okay. Yeah. It's 1.
So the
The
tax
equity
is
is
what? Tax is what?
The question.
No, sir, please, can you display the question? So
Can we screenshot the question?
corporate tax is 30%. It's normal rate.
This is the question.
It's 30%.
It's,
It's
it's
normal
30%.
tax rate.
thank you.
So have you screenshots?
Yes, sir. Thank
No,
you.
sir.
Yes, sir.
This is it. So the tax is 30%, 0.3. So once you simplify, you have what? Your asset beta will be what?
$1.177. 1.177.
Can we just approximate to make it one decimal place? 1.2.
Okay.
So after this gearing, what will be the next thing? The next step is what?
Regear.
You reject.
You regear. So what will be the formula now?
Yes, regear.
Regear.
It will be
Better equity
beta
gear.
equity G equals
Better
Sorry.
assets.
into 1 plus.
Did everybody get it 1.2?
Yes.
Okay. Yes, P is the formula.
So when you regear, you're trying to get the equity beta gear of of which of P now, right? Of P, because you determine the business risk. So you are trying to incorporate the business risk into your own structure, into P structure. So now, for you to get the equity beta, your asset beta derived is what? 1.2, right?
Yes.
1.2. 1.2. 1.2. So your tax is what?
30%.
0.3. And your D will be what?
Okay.
1.
Debt, okay.
Your D will be what?
D is 1.
1.
D is 1.
Yes.
Now, you are done with Moyo. You are now working with me.
Yes, exactly. I just wanted to ask.
Sorry, Mr. Tope, that
5.2.
P.
Wait, the 5 is
So it will be
2.
it will be 5, right? 2, right?
No,
That is
2, yes. Yes, 2.
2.
2.
Equity debt is 5 is 2.
And the equity will be what?
2.
5.
5.
Equity will be 5.
That's not Moyo.
Equity will be 5. Sorry, let me see some.
1.536.
What do you have?
1.536.
1.536.
That's a 1.536.
That is overall, right?
Yes, sir.
Yes.
Let's maintain the one decimal. Somebody not getting it. You need to apply your board mouse for you to get it appropriate. So when you regear, what will be the next thing?
You calculate the cost of equity using
Using
capital asset pricing model.
So you apply a capping formula. Capping. And the formula is what? RF. They apply the capping formula RF plus what? Plus beta. It's a beta. It's a beta. The bracket of what? Market return. Less what? Risk free. So based on the question now, this capital is to get your cost of equity. The cost of equity. Based on the question, our risk-free will be what? The risk-free rate will be what? It's not clearly given.
That's
As a gross redemption yield of
11%.
as a gross redemption yield. They didn't state it that this is risk-free. The interest associated with that is what? Associated with the risk-free is what?
11%.
1%.
11%.
It's 11%. 11%. So when you put that in, 11%, what is your equity beta? Equity beta derived is what? 1.5.
1.5.
Now, your market return is what?
Beta equity. Market was
1.2.
equity beta. 1.5.
Market return.
16%.
16%.
16. Is the statement of bond.
The average return on the stock markets. 16%.
16%. Then your risk free is what? Still what?
Which is 11%.
11.
Gross.
11%.
11%.
Gross point.
So once you simplify, you have what? Once you simplify, you have what?
11 plus equity beta.
18.5.
Equity
beta. 1.5. 12. 2. 16.
18.5%.
Market return.
You have what?
18.5. Yes, sir.
Yes.
18.5, right?
Yes.
18.5. So this your cost of equity. We'll now use the overall formula, WACC. We'll now substitute and use our WACC formula.
26.
The WACC formula is what?
26.
The WACC formula.
Cost of capital.
Cost of equity multiplied by equity plus equity plus debt plus cost of debt 1 minus tax.
Explain.
Yes. So once you
the last
substitute, the cost of equity is what?
18.5.
18.5.
Yes.
Multiplied by the equity value is what?
Is it 14 now, Moyo?
It's 5. No,
We
Equity.
5.
yeah,
What do you mean? 5.
so 5 plus 2. We work on that
2.
order. Yeah. Plus what? The cost of debt.
Cost of debt.
The cost of debt. The question, let's see, and the corporate debt, which is assumed to be risk-free, has a redemption yield of
11%.
11%.
11%.
Still 11. The 11% the cost of debt. The tax of what is
30.
30%.
30%.
I said, go over. Now she got open.
I like who they speak outside here.
No, no vessel, my husband.
So for the other part of the formula, D is what?
G is 2.
Yes, so you solve in that order.
Yes, sir.
Please, Mr. Topper, I need the solution page. Okay, thank you.
So once you do that, your final result will be what? So what do you have as a final result? Is anybody getting 15.4%?
15.4, yes.
Is everybody here getting 15.4%?
I got 15.4.
Madam Chidima, Madam Nobu, Madam Tolani. It's only roots.
I've not gotten it. I'm still working on it.
All right, work on it. Follow board mass.
Hello, Mr. Tope. The step 2, second step, the one for the finance risks. The final
Yes,
answer there, I'm
yes.
a little bit confused. Okay, no, I'm referring to
Okay.
the second step. 11
Yes.
plus 1.5.
Yes.
11, 11 plus 1.5. So if we are applying a Bodman's post, that means 11 from 16.
Yes.
Okay.
Times
No, I
1.5.
got 17.5. Hello, sir, are you with me?
17.5.
That was my own,
Sorry,
so I'm a little bit confused.
it's raining, so I'm trying to strain my ears.
Eh, yeah, sorry.
You can do
So
it
let
like this:
me go
16
back to that.
minus 11 times
Okay.
1.5 plus 11.
Okay, 16 minus
11
yeah. I first of
times
all did the one inside
times
brackets.
1.5. Yes, times 1.5
Okay,
plus
before
11.
addition.
Yes.
All right. Okay, thank you.
All right. So that is fine, right?
Thank you. Yeah, yes. She has explained, so I'm clear now. Thank you, sir.
Mr. Tope, what do you get as the final answer?
Final
15.4.
answer should be 15.4%.
Okay, sir.
Are you there?
Yes, I can hear you, sir.
So if you are fine with that, I forwarded the question on the WhatsApp page.
Please help me scroll it down a little. No. All right, sir. Thank you.
This
I
question,
forwarded the question.
literature.
I forwarded a question on the platform. That is Ferrari PLC. It's a very lengthy one, but the major point in that question is on the additional data given. That is extracts from statement of financial position. Extracts from statement of financial position. The loan notes of Postaris PLC are quoted at this. So we have two organizations, Ferrari PLC and Postaris. I think Postaris is a proxy company. Ferrari want to venture into Postaris PLC business. So if you look at that additional data, you can see non-current assets, working capital, 6% bank loan, 5% loan notes, share capital at 0.5 per share, 1 naira per share, reserves, current market value per share, quoted, beta, and the rest. Loan note of Postaris PLC are quoted at 102 naira per 100 naira. So, other data, tax rate applicable to Ferrari PLC and Postaris PLC is 20%. it can be assumed that tax is payable in the same year as the profit on which it is charged. So estimated risk-free rate of return is 3%. Historic equity market risk premium is 6%. Required, given the information on Coscaris PLC and the project financing risk, including any other relevant information, calculate the project-specific cost of capital. Now, looking at that question, though I didn't read from beginning because all those other stories are not relevant, too relevant to the A. But if you are not careful, you will now begin to think that this is a 30 marks question for SFM. I just take the A part of that question. The A part of that, so specific cost of capital. The first thing to do is to identify the proxy beta. The proxy beta. If you check the question, if you open your WhatsApp and check the question, you see quoted beta. This is given free of charge now. Quoted beta. You see Ferrari PLC 1.3, Coscaris PLC 1.8. It means the proxy beta of what? Of Coscaris, of the proxy company is what? Is 1.8.
Please, can anybody still hear him, or is it my network?
Okay, I'm back. That's a few minutes. All right. So regarding that question, that once you identify the beta, which is 1.8, now for Coscaris, their equity is what? The equity value is what? For Coscaris. The equity value of Coscaris is what? You need to work for that. You need to solve for that because you have 500 million shares quoted at what value now? If you check the financial statement, 1 naira per share. Coscaris 500. So it means how many shares is Coscaris having? 500 divided by 1, isn't it? It's 500. What is their current market value? The current market value in the question is what? Current market value per share. Coscaris is what?
3 naira.
3 naira. So 500 million shares multiplied by 3 naira will give you what? The equity value. The current equity value, which is 1.5. Now, what will be the debt value of Coscaris? The debt value of Coscaris will be what? The debt value of Coscaris will be what? They have what? 368 naira, right? For now, 5% loan notes, 368. I'm just trying to give some hints so that you work it out. 368 currently. Now, it is currently quoted at what? The loan notes of Costaris PLC are quoted at what? 102 naira per 100.
100
So
naira.
what is the value of the loan note? It will be what? 368 divided by 100, right?
Right. Yes.
Multiplied by 102. You have the
Yes.
current market value because debt is in what? It's valued in 100, based on 100 naira. Yes. So 102, 368 divided by 100 multiplied by 102, you have the debt value. So the total value of post carries will be what? Should be 15 plus 375. That will be the total value. So you can now substitute into this second step in relation to the beta and the rest of it. So you can also do same for what is it called? For Ferrari. For Ferrari. And see how we can get the WACC. The WACC. So because
Ferrari
of
don't
those,
have
you said?
loan notes. Ferrari don't have loan notes. Okay.
Sorry, I didn't get you.
Ferrari, you said we can do same for Ferrari.
For Ferrari, you can just work based on the equity value for Ferrari. That is, let me see. For Ferrari, the equity value, they have 6% bank loan notes. Bank loan.
Yes.
Yes. 6% bank loan. 6% bank loan. And they are not giving us the current value. Yes. So it still maintains 624. Still maintains 624. So, but for the shares, how will you compute the shares? The shares. How will you do that? So that will go now.
Divide by 0.5.
Okay, that is 208 divided by 0.5, right?
Yes. Okay.
You have 416 million shares, and it is currently quoted at what?
1 naira per share. Oh, sorry, 3.5.
3.5.
Okay.
Yes, 3.5. So 3.5 multiplied by 4.16 million shares, you have the equity value. You have the equity value. So you can just try and make attempt. Yeah, I know what we are saying. Some of you might not get it per se because of time now, but just try, read it, try and come up with something. Yes, that is the strength you need for the exams. Yes, try and come up with something and let's see and get better. Try and analyze the question. That is the strength you need, so that when you see questions, you'll be able to bring forth points as it relates to it. Yes. So when you solve very well and you want to know if you are right, you should get your WACC. You should get something like 12%. You should get something like, yes, approximately 12%. Yes, that is your final answer if you want to know if you are correct. But me too, I'll work on it, and then once you send your solution, I will forward my own solved solutions to you too. So just try and come up with something. Yes, based on that question. So all those long paragraph of stories, they are not too relevant, but read it and see if there's anything relevant there. Then you pick. Those stories are for the other part of the question, which I didn't forward to you because it's not part of what we're talking about here. So thank you very much for your time. So
Thank you, sir.
we are gradually moving. I will check the syllabus. Then there are questions I want you to solve before let me go and check for them. Assignments. Okay, I think this is an assignment. I'll forward it in slide 2. This is an assignment. And quite a number of questions in the slide. You can attempt them, fine. Yes, quite a number of questions. So, and I will check for other questions to unfold. So, I will look at the syllabus. There is a part that is a reading part again, as part of this syllabus. This aspect of cost of capital. So I will check, and if I can summarize the aspect in the study pack, I'll summarize it and forward to us, so that gradually we should begin to look at issues of foreign exchange, hedging, how to guide against fluctuation in exchange rates and the rest of it, in terms of spot rates, futures, options, and the rest of it. Is also a very key part in the syllabus. So we keep communicating. Thank you very much.
Thank you, Mr. Tucker.
Thank you, sir.
Thank you, sir. God bless you.
Good.